Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. With me is Shell Bhatnagar right here in the studio, and this is BTS. Behind the Scenes, a show where we share a sneak peek into the latest edition of the Business Today magazine with all of you viewers. I have the magazine in my hand and it will surely reach you out onto the stands as well that you must grab a copy on. On this edition, we're going to be talking about the 100 best mutual funds that we have compiled for you in this special edition as well. This is truly the Mutual Fund Investment Guide of 2026. Just to set the context right, back in the year 1993, when Business Today, in partnership with Value Research, asked one question to viewers and, of course, readers: which mutual fund schemes are worth investing in? It was that question that remains powerful even today as much as it was then. From just about 89 schemes that were just investable that time, the universe of mutual funds has expanded to more than 1800 as of the previous month, that's September. This freedom of choice empowers investors but also makes difficult to choose the right and challenging as well. Now, this partnership with Business Today and with Value Research that set a benchmark as first such ratings in India back then. Together, they pioneered the mutual fund rankings in an era when private sector was taking the first steps into the world of fund management. Today, 32 years later, we are back with a renewed relationship and bringing back a thicker, much better and a much deeper conversation and detailed research on the world of mutual funds. Let's actually welcome two of our external experts also on this program. Mr. Dhirendra Kumar, CEO Value Research, is joining in on this program with us. We also have Devang Shah, the head of fixed income at Axis Mutual Fund, joining in onto this program as well. Warm welcome to all of you. Thank you so much for taking the time out. Dhirendra, this is in many ways nostalgia for you. 1993, you were just talking to us about what was world like back then, what was the mutual fund era back then, how did you come up with the first ever ratings, and 32 years later you have a renewed account of 100 best mutual fund schemes that we've put out for all our viewers to see. Give us your sense and your personal anecdote that you've also penned down in this edition for all our readers.
Yeah, I've written a column, and this is not just nostalgia. This is documenting our legacy. This is inventing the first ever risk-adjusted performance rating, which got published. Fortunately for us, it all got documented in print. Otherwise, if I make a claim, what you are showing on the screen is actually reminding me what was going on then. It is taking me back 32 years, 33 years. And I owe it to the editors of Business Today. Because there were little over 80 funds. The private sector was getting started. Choosing funds was complex even then, but not that difficult. But today there is a problem of plenty, and today we are even more relevant. And mutual funds were in a state of infancy. And even today with 1800 funds and the kind of penetration we have seen, and we have reason to be very happy about it, but I still feel that these are still early days. We are still in the state of infancy. And this issue of Business Today is a step in that direction. One problem which most investors face is, okay, mutual fund sahi hai, which one to invest? Here is the answer.
Okay. Dhirendra, it's been a wonderful journey spanning 3 decades in which there used to be that one scheme, US 64, and now 1800 that are that you track so diligently on a regular basis. This, ladies and gentlemen, is the 100 funds that have been ranked by Value Research in terms of creating long-term wealth even from now. Dhirendra, could you just share with us the methodology which went behind choosing these funds, which are spread over 5 categories? There are diversified equity funds, there are index funds, mids and smalls, hybrid, and of course debt. What made you choose these 100 out of 1800?
One is that we wanted to keep the classification simple, because SEBI has gone about classifying it in a very scientific way and in a very detailed way, which adds to the clutter, which adds to the confusion. Today, officially, there are at least 40 kind of mutual funds. 40 different kind of mutual fund actively managed. Beyond that, there is a wide array of index fund which is possible. So we kept it purely an investor's objective in mind, his goals. There is a person who is investing for the long run in investing for the long run in equity,
Nice.
and for him this is the diversified equity. There are investors who are little evolved, they are willing to take chances, they can withstand the ups and downs, severe ups and downs, and for them it's the aggressive growth fund. Then we have the hybrids, which is basically a steadier take on growth, and the fixed income, which is, we have kept it very simple. We have kept liquid fund for the heck of presence. There are people who will need liquid fund, but it does not require any analytical rigor. If you happen to choose a not so good liquid fund, you won't be disappointed. And most naive individual fixed income investors investing through mutual fund, their needs are generally reasonably fulfilled with a short duration fund. So that is why we have kept it very simple. And it is not a performance rating. It is not looking at 1 year, 3 year return. It is looking at 1 year, 3 year return and what is the process guiding it and what it is translating into the downside risk, the consistency of it, and risk adjusted performance, which is at the heart of our rating system. So these three factors tends to give us an input in terms of how likely these, of course, past performance is unpredictable, will not be repeated in future. But the basis of these ranking or this rating or this selection or the top 100 is that they are more likely to repeat because it is rooted in the process than the randomness.
Right. We also have with us Mr. Devang Shah, Head of Fixed Income at Axis Mutual Fund. Devang, you've also been a part of this journey over the last 2 decades or so, in which mutual funds have moved from, basically two Western dominated cities, which was Mumbai and Ahmedabad, to pan India. How have you seen this journey, and what has been your 2 or 3 learnings that have come out from this 2-decade experience?
Yeah, so I think first of all, thank you for having us. As you rightly highlighted, I think, and Dhirendra can vouch for all this. I am on the fixed income side, and I'll just tell you how the journey has been for fixed income funds for the last 20 years. And as Dhirendra highlighted, I think first of all, the regulator has done a superb job.
Yes.
I remember when we had joined the industry, and in 2004, 2005, the funds were actually overlapping, and we could, at that point of time, there were no restrictions on maturity, then there were no restrictions on ratings, and there were a lot of confusion for investors. When I look across at the last 20 years and I've seen how the streamlining of the industry has happened, today we have defined categories on income.
Yeah,
And
please carry on.
Please continue, sir.
yeah. So if you look across it, there was a time where over the last 20 years, we've actually seen the evolution on fixed income funds. Today, if I see, there is a fund for every investor and a fund for every time horizon when it comes to fixed income. Like if you need parking solutions for 1 day, if you need parking solutions for up to 1 year, if you need your goals-oriented funds, which you can probably target for the next 3 years, or if you need money for your retirement and you are a fixed income investor, conservative guy who wants to probably invest for the next 20-30 years. We have a fund from 1 day to 30 years. And hence, I think somewhere down the line, our perspective is that thanks to the regulator, thanks to the evolution of the industry has actually grown manifold from physical format, from a branch format now to an online app format. We see the entire journey of investing significantly simplified. And I think thanks to the regulator and thanks to the entire industry, which have taken significant steps to ensure savings in the right channel.
Absolutely. Dhiren, coming back to you, you've selected these top 100 funds. Now, these are not rankings, but we have just chosen that out of the 1800 schemes, we are selecting the top 100. Could you give our viewers a sense of why do you think these 100 are the best fund schemes at this point in time and not the rest of the 1700? How would you look at it?
For equity fund and for the fixed income fund and the hybrid fund, it is entirely rooted in the discipline of the underlying fund. Besides that, these are broader categories. In fact, we have chosen to, we did choose to ignore all the exotic categories, all the categories which are narrow. thematic fund, all the sector funds were ignored for this analysis. We have not looked at the opportunistic part of it. There, the investors can explore themselves and figure out things. We have kept the naive individual investor in mind while doing this work. That if you want to invest for the long run and want to invest in equity, these are the funds, because they will give you broad exposure to the market. They have demonstrated their ability with their stock selection, with creating a superior, by generating a superior performance, and they demonstrate a process which looks replicable, and that is the primary driver. I'm not saying that these are bound. There will be funds which is beyond this top 100 which might do well, but all I'm saying is that these funds are showing the symptoms where they are more likely to be replicated. Their performance will linger, and they are unlikely to give nasty surprises. That was our primary concern. In fact, when it comes to all these rankings and all kind of tallies which we see over time, most of the time we are enamored by the outliers, the top leagues, the things stacking up, the top 5, the leader, the top 3. But what hides in that top 3 or top 5 is that it might have assumed some unusual risk, unprecedented risk, and the risk may not have shown in the recent past. Here we have gone by a method whereby the replication or the sustainability of these performance looks more likely, and that is what we have taken a separate method for hybrid fund, likewise for fixed income fund, who is showing greater consistency in their approach to stock selection. They're managing their liquidity. Different criteria guides different categories, but primarily equity, hybrids, liquid, and debt funds.
Okay, ladies and gentlemen, this is a 178-page book which will soon be on stands, and it has to be a part of your daily reading at least for the next 1 year, if not for the next 5, or whenever Dhirendra comes up with the list of another 100. Dhirendra, I wanted to understand what has been your own learning over the last 33 years. You've penned down a wonderful article in which you've mentioned 5 basic points that even naive investors can keep in mind and make supernormal profits as also retire wealthy. What are those 5 things?
One is that, in fact, it is little more than 5, but nevertheless, the most important thing is everybody starts. I meet somebody in a party or in a function, and somebody will say, "Tell me a good fund." I think that should not be the starting point. The starting point should be, what is my goal? What am I investing for? Few days, few months, few years, or many years? And that is the answer which only resides with you, and that should be the guide. Second is that never invest in equity at one go. And next step is choose a good diversified fund, and this is where this top 100 selection will come in, because in this top 100 there are about 30-40 funds which are from that category, the diversified equity category. Many a times investors getting started, they get quite investing is a very hard step, because you are postponing today's consumption to invest for the future, and the beginning is very hard. With that in mind, most investors find an excuse why not to do it, and one of the excuses that I can't choose a good fund. If you can't choose a good fund, start with an index fund. If you can't choose a good fund and you can't choose an index fund, go with an aggressive hybrid fund. At least it will be a steadier take, and you will never get scared. So if you follow these 3, 4, 5 rules and invest for the long run, means long run, 5 years and more, and SIP. That is it. If you do it for 2, 3 years in an aggressive hybrid fund or an index fund or a diversified equity fund, which we have chosen, I think you will come back happy and thank us.
Fantastic. Devang, bringing you into the conversation as well. We also have top 10 debt funds from this space as well. Aditya Birla Sun Life Liquid Fund, Aditya Birla Sun Life Short Term Fund, Axis Liquid Fund, Axis Short Duration Fund. We have Baroda BNB Paribas Short Duration Fund, Edelweiss Liquid Fund, HDFC Short Term Debt Fund, ICICI Prudential Short Term Fund, Mirai Assets Short Duration Fund, and Nippon India Short Duration Fund as well. Now, when it comes to the fixed income fund, funds and debt funds that one has to really incorporate in their whole overall investment portfolio. What is it that you tell investors as to what is the best selection criteria one must go with?
Yeah, so thanks, Sakshi. So, see, I think the certain parameters which always investors should look across is first and foremost for any fixed income investment is your time horizon. Because if you are looking at a very short term parking solution, then and if you look you buy a gilt fund, which is a long dated duration fund, or you buy a dynamic duration fund, which has sensitivity to interest rate environment, you can actually feel volatility, and the experience of the journey of the investor might not be so good. So how I always put across things is first and foremost, the foremost requirement of selecting a debt fund is your time horizon. The second thing is your risk appetite. I think somewhere down the line, what happens is SEBI has done a good job again by highlighting certain factors. If you go through a fact sheet of a debt fund, you get a riskometer and a PRC value, which explains you what are you investing into. And that is what is the foremost thing which the investor should look at. That, okay, this is my risk appetite. Do I need to buy, am I okay with buying a credit fund or not? Do I want to buy a quality bias funds? Actually, as I told you, SEBI has done a great job whereby we have categorized funds as per the duration and as per the crediting criteria. So if you're generally sensitive to accrual based lower credit funds, you can actually select lower duration funds and high quality bias funds. So I think the focus should always be on your duration, time horizon of your investment. Secondly, the internal risk appetite of the investor, which can be measured through a PRC matrix or through a riskometer. And the third foremost perspective would be what is your return expectation. If you're looking at just a kind of a small alpha over traditional solutions, then you can, as I think Dhirendra highlighted, short duration funds over the last 30 years, it has actually shown as a trend that it actually takes care of your, it beats gilt funds, it beats dynamic fund over a 3-year rolling perspective. So how we look at things is for an investor who is looking at parking solutions, you should always look at the very short end of the curve, and be it overnight or liquid is a good solution. And who are looking at medium-term debt allocation, I think short-term funds comes out to be a good solution. Just to close my comments, a new category which has started now from thanks to the clarification of the taxation bill and SEBI, which is income plus arbitrage fund of fund. I think this category makes a lot of sense going ahead for investors, because it's a combination of 65% up to 65% debt and 35% arbitrage. And the blend of the two, if you own it for 2 years, it actually being classified as a non-specified mutual fund category, where the taxation benefit kicks in and you are taxed at 12.5%. So the debt funds which had actually lose some interest with this invention of the new category, I think will significantly interest investors from a medium-term perspective.
Right. Dhirenji, we have this list of 100 fantastic funds spread over 5 categories. Now let's get down to the practicalities. There are 3 kinds of investors. A large chunk of them are new ones who've entered the market in the last 5 years or so. Now for them, what would be their first step into the world of equities via funds? What would you suggest they do?
For anybody who is getting started and is 22-year-old, confident and full, very confident of himself, starting early and with sizable savings, he can well start with a mid and small cap fund. I really don't care, if somebody is sticking around for 2-3 years, he'll be better off with this because he can withstand. The only point is that he should be doing his SIP, not invest at one go. And that way he will have a choice of funds with great credentials. If somebody has crossed 30 and should do his SIP, the diversified equity fund universe, we have chosen 40 of them. You have of which about 8-10 of them are tax saving fund. Ignoring them, you have a good choice, good number of funds to choose from with impeccable track record, very consistent track record demonstrated over the last 5-7 years. All these funds, the point of BT 100 is that all these funds are with credible history, and we know what they stand for. They have demonstrated what they will never do, and so that's the other thing. For somebody getting started and doesn't understand funds, has heard that investing in index fund is smart, For them, we have given them 10 funds which are primarily on low expense and great replication of the index. So get started with any of the three categories. They are meant for different people.
Okay. Dhirenji, also help us understand your outlook, since this right on top of the cover we also say that this is the mutual fund investment guide for 2026 as well. So like Shell said, that this is going to be in terms a referral book for all the investors to probably keep going back to it and reading it and seeing whether they are investing in the right fashion for 2026. Give us look at the broader lens and help us understand in the mutual fund universe, what is your expectation, where can one really make maximum money?
One can make maximum money with the aggressive growth universe. I'm very confident of that. But one should not undermine the impact of what is one should not forget that in 2008 or in 2020, what happened? Because a large number of investors, in fact, we have half of the mutual fund investors in absolute numbers, not in terms of their value of holdings. They have come in the last 3-4 years. They haven't seen a decline. And if they are faced with a situation where the market falls freely, and markets are like that only, they will go steadily up. They have done very well. But all those investors who have not experienced a sudden big decline, will they be able to withstand it? With that in mind, I think the diversified equity or the aggressive hybrid funds are a better choice. But for anybody who's doing his SIP, he can feel happy that most of his investments are yet to be invested, and he can withstand that. Mid and small cap universe, and 20 of them. And we are very hopeful that of this is going to be a wealth builder segment for most investors.
Dhirenji, at one side of our wonderful market on Dalal Street is the mutual fund industry, and the other side is the world of futures and options, where 9 out of 10 traders generally make a loss. Now, for all those who've lost crores and crores of money at a time when it is very hard to find even a single mutual fund investor who's unhappy over the last 5 years, how would you suggest that people give over their addiction of FNO and move towards sensible investing?
I would not suggest. I would just encourage them to do whatever they want to do as early as possible so that they can learn. Because, the money issues or the investment issues, the lessons you don't learn from other people's mistake. You have to lose your own money to learn it. And learn it as quickly as possible, because that will be cheaper. You won't have too much to lose.
Devangji, bringing you in there, and I also wanted to ask you, since Shell also pointed out that first time investors who've entered in the last 5 years, most of them are young investors. They're very aggressive, very aware. They have come to realize that mutual funds sahi hai, like Dhirenji also pointed out. For a young investor, what is the importance of having a fixed income fund in their overall investment portfolio? If they say that we are very aggressive, we have a long way to go, why should we even think about fixed income? What is that you would say?
See, our perspective always has been that, obviously, so you rightly pointed out, as the investor gets more into the matured age, the allocation towards fixed income generally increases. But I think we have not, one theme which we have not discussed today is an asset allocation theme. Okay, and somewhere down the line, it is very important, because time and again, in the last, we have done some study for our investors, where we actually look at 20 years data from 2005, and we'll be all surprised. And we actually did some 6-7 asset class and tried to do a study where which asset class comes out to be a clear winner in all different market scenarios, be it like COVID, global financial crisis, demonetization, credit crisis, every tangent. Okay, and let's look across a larger time frame. What we saw, the results were surprising. Okay, general consensus would be that equity would have done good over the last 20 years. Okay, but it's only 5 years where equity comes out to be the top performing asset class. In fact, other way around, the second myth is that gold would have done that very good. Okay, it is only 1 year over the last 20 years where gold has done and performed to be the best performing asset class, and vice versa. Silver and fixed income, which is not generally expected that they will do good, fixed income came out to be the best performing asset class for 2 years and silver for 5 years. So the point we're trying to put across is that it is yes, the young generation or general the people would think that equity is the best performing asset class or the way to go. I think if we focus on multi asset allocation, or somewhere down the line the thought process would be that you do a follow disciplined asset allocation at all point of time. That is where I think fixed income allocation comes and makes an important perspective for even the young generation. So our view is follow a disciplined asset allocation, outsource your investment to an institution whereby you are actually guided by professional setup.
Dhirenji, this brings the other extreme into the discussion, which is just too many funds in many portfolios. We come across many of our friends and many of our families, who have, the maximum that I have come across is 42 funds in a single portfolio. Now, how much is enough, and what is the maximum number of funds you should be having in your portfolio for decent wealth creation without any headache?
One is that for most people, getting started, one fund is good enough. Once you have built it up, maybe 2-3 of them are good enough. And after that, and if you want to really keep it simple, if you commit to the principle that you are not going to exceed beyond 4, it is possible, because 4 funds gives you a 2 or 3 funds gives you meaningful diversification. You get exposure and active management, brilliant team at work for you, for a very small cost, and you get all the benefit. The problem is that mutual fund is also a consumer product. It is being pitched as a something new, something special. It is always vying for your attention. And somebody will be launching a fund and you will get curious, you will get attracted, you will buy into the story. But, and today, earlier I used to say, before 2018, when consolidating your portfolio was very simple because there was no capital gains tax. But today I have a different story. The different story is that don't consolidate your portfolio mindlessly. There is a cost of consolidating your portfolio. Make sure that your portfolio, the mutual fund that you hold are good. If they are not good, by all means sell it and replace it and consolidate in fewer funds. 2-3 funds can give you meaningful diversification for a lifetime. That is why I keep saying that invest in a fund which is better diversified. Don't get into sectoral, thematic, or a narrowly focused fund, because they will do exceptionally well at some time, and they will do exceptionally poorly on the other occasion. And every segment of the market, every asset class is cyclical, and that is when they will disappoint you. So keep it simple. Choose few funds from a diversified category. Be at it for many years. Don't jump out of the fund on a brief period of underperformance, because best of fund managers go through a lean period, and that may not be end of it.
Well, your last line is by the cue for my next question, Dhirenji, and that's with respect to the fund managers. We've also called out the top 20 fund managers list right here as well. And I wanted to ask you, we have Rajiv Thakkar, Roshni Jain of HDFC Mutual Fund, we have Niket Shah of Motilal Oswal Mutual Fund, Shankar Narain of ICICI Mutual Fund, Tahir Badshah of Invesco Mutual Fund, and so on. We have so many of them. What is the importance of selecting your fund based on the fund manager? What does one really need to go through and decide when it comes to the fund manager?
One was that looking at their performance over a full market cycle, because in the absence of a full market cycle, it's very difficult to attribute the performance of a fund, whether it is luck or whether it is his brilliance, or whether it is his brilliance coupled with his systems or a process. And with these people, with this set of fund managers, we were able to verify and validate that they are following a method which looks replicable and that shows in performance as well. And so that is one. And not only that, we have looked at some of these fund managers who have worked through multiple companies. They have moved around managing different funds at different fund companies, And we have ported their performance at one place to another, and look at their performance and their performance vis-a-vis their peers, vis-a-vis the benchmark, and their consistency, their style. And this is what, and that led to narrowing of the fund managers to this set, and who have been able to demonstrate that they have some tricks which, and they have the wisdom which they have captured, and over a period of time.
Dhirenji, we will have to sort of drill it down a little further. What you
Yeah.
have done is given us top 100. Now, I am going to pin you down further. In each of the 5 categories, I am going to ask you 2 funds that are closer to your cerebral understanding of creating long term wealth. We will start with diversified equity funds. 2 out of 40.
2 out of 40.
Yeah.
That is narrowing it too much. But I would rather say 3-4 out of these 40 will be a more desirable thing. Say something like Axis Multicap, or ICICI Pru Value Fund, or Motilal Oswal FlexiCap. And also, I'm quite tempted to add, a fund which normally we say that don't get into the diversified category, but Nippon India Large Cap Fund. It has demonstrated something over a full market cycle, where in a category which struggles to beat the index consistently.
Okay, we leave the index funds aside, but your 3 or 4 favorites in the mid and small cap space.
Axis Small Cap, undoubtedly, and Bandhan Small Cap. It has done brilliantly, and it has turned out to be the most rewarding fund over a period of time, even on your SIP. And in fact, here is a category where the turbulence, or the mad turbulence of this category, works to an investor's advantage, and your discipline gets rewarded. Likewise, HDFC Small Cap Fund, it has it's been very impressive, and Tata Small Cap too. But
Absolutely.
I'm just telling you based on from the reading of these 20 funds and what is just crossing my mind. It's not a very objective assessment. I think look at the scorecard to arrive at your numbers yourself, because we have given a very elaborate information docket on each of these funds for you to arrive at. It is
And
great to-
yes. Let's look at the hybrid category. This is something that you have often advocated should be the first step in the market for young investors. Build up a portfolio of equity plus debt. Debt will provide you cushion, equity will provide you the kicker. Maybe 1 or 2 funds from the hybrid space that you like.
No, that is what Devang was saying, and this is something which actually goes unnoticed and less talked about. Asset allocation is critical, and doing it practically is taxing, at the same time complex. If you invest 100 rupee and if you have to rebalance every now and then, it is complex. If you invest in a hybrid fund, aggressive hybrid fund, a fourth of your money is in fixed income, 3/4 of it is in equity. It keeps getting rebalanced without any tax implication and without any headache. Choosing few funds, I think the old, the one which I have believed for a very, very long period, and that was erstwhile a very celebrated fund, turns out to be the largest in the category, is HDFC Balanced Advantage, which did not start as a Balanced Advantage fund, started as Prudence. And ICICI Prudential Balanced Advantage too has, and likewise Nippon India Aggressive Hybrid. These 3 funds do come to my mind, and this is a fund, if you come across any person who is 40-year-old plus and is still struggling to start with mutual fund for the long run, this is the category when they should be diverted, and you will not be embarrassed meeting him again.
Hey, Devang ji, since you also feature in among our top 20 fund managers as well, so first up, congratulations, and do help us understand, if all our viewers want to seek from one of the best fund managers that we have in the country in the debt category, what should one expect in the year 2026?
Yeah, so see on the fixed income outlook, what is our assessment at this point of time? And if you actually read through the minutes of RBI, first of all, I think the policymakers have done a superb job over the last 12 months. I think a concentrated effort to ensure that whatever downturn in the economy could have happened because of credit slowdown last year and somewhere down the line, the entire tariff issues right now, I think they have done such a great job whereby somewhere down the line they have cushioned the economy. But when I look across from a fixed income perspective, what is important for rate cycle is inflation and growth dynamics. And today, when we look across at inflation, thanks to the GST cuts, which is just came into mid-August, I think somewhere down the line, the inflation outlook continues to remain benign for the next 12 months. Again, when I look at the growth outlook, it still remains patchy because we all know that there can be a tariff implication and the growth impact could be in the medium term. So unless until we get a settlement on the trade deal, I think the growth uncertainty continues with the policymakers. With that context, where we have a patchy growth cycle, benign inflation, I think RBI has some monetary space limited monetary space opened up, and we believe that there can be a one or two rate cuts in this cycle. But it is important for the investors to understand that the last 12 months has been phenomenal for fixed income funds, where short to medium term categories have all delivered 8 to 10% kind of returns. I think it is important for them to understand that incrementally with limited capital gain cycle, returns would be muted. And somewhere down the line, the focus at this point of time for fixed income markets should go on accrual themes. As I told you, from a medium term perspective, who an investor who has a slightly longer term horizon and who is conservative, I think the new category, which is income plus arbitrage fund of fund, is a debt like solution and a tax efficient solution for investors, which a medium term conservative debt investor should look at as an investment opportunity.
Okay. The final word, Dhirendra, goes to you. The last 33 years have gone by in a blink of an eye. Time, as we all know, runs faster as we age. How do you see the next 33?
I think we are beginning. We are still in a state of infancy. When I see is mutual fund a mainstream, the mainstreaming of mutual fund is beginning, and we have miles to go. If you look at anybody's wallet share, how much deposit he has, how much of other assets he has, and how much of it is invested in market, the biggest hope has come from the ecosystem. When you look at the payment mechanism, when you look at the digital infrastructure, the way you look at the KYC mechanism, the way you can invest in 15 minutes in a mutual fund. I started this mutual fund rating at a point when the mutual funds NAV were disclosed every 3 months with a 2-month lag. Putting together some scattered data on these 85 funds was my great advantage. Today there is a problem of plenty. So I think these are still early days of mutual fund. We still have a lot of demystification and education which should be initiated. A lot of people still, in a country when so many people are investing through mutual fund and are having a positive experience. At the same time, we have the bigger growth has been as the number of demat account and the number of active traders in the market, and 92% of them lose money. And 92% of them lose money is actually one part of the story. They start their financial experience with distrust, with disappointment, which I think is bad news, and that I think is a great opportunity for mutual fund.
With that, ladies and gentlemen, we'll draw this to a close. But remember, this is a new beginning, a wonderful compendium of 100 potential wealth creators. And remember, many of them will be multi-baggers. Many funds that Dhirendra has reported upon and we've tracked over the last 20-25 years have given easiest multi-bagger returns. Many fund NAVs have moved from 10 rupees to 2000 rupees in the blink of an eye. Let's hope for the best, and here's wishing everybody a great journey ahead as far as wealth creation is concerned through this magazine done up by Business Today and of course Dhirendra Kumar. Thank you, gentlemen, for your wonderful time, and here's hoping all the best for the markets in the years to come.
Thank you so much.
Thank you, Sakshi. Thank you, Sachin.
Thank you.
Thank you. All right, viewers, we'll wrap it up on that note on this special edition. The Mutual Fund Investment Guide of 2026 is here. In case you've still not got your copy, please go out.
Yes.
This is a copy that you must keep in case you are looking for starting your investment journey. You're already in it, but you were still not sure whether you are in the best of funds. This is your guide as well. And in our continuation of this series, over the next 1 month, we will bring you all the exclusive conversations from these best fund managers that we have got an interview of in this magazine as well. Shell and I will be constantly speaking to them to detail about all these 100 funds, or at least these 5 categories, as extensively as we can. We promise you that. So don't go anywhere. Business Today is your place to be for all your mutual fund understanding. Thank you so much.